I just want to welcome our guest speaker, Vitaliy Katsanelson, who's the CFA. He's the CEO and Chief Investment Officer at IMA, where he joined that firm in 1997. He's received both his Bachelor of Science and Master's of Science in Finance from University of Colorado at Denver. His two books, Active Value Investing and Little Book of Sideways Markets, were both published by John Wiley and Sons and have been translated into 8 languages. I think he actually has had a third book since this bio is written about the electric vehicle market. I've downloaded that, but have not yet read it. That's on my summer reading list, Vitaliy. So I'll know a lot more after I read that this summer. But his articles have appeared in Barron's and Financial Times, Forbes, Business Insider, CNBC, Globe and Mail, Market Watch, among others. One of his two books here. He's also been a guest on CNBC, Fox Business, BNN, and Yahoo Finance. Kind of a funny little story. After I had reached out to Vitaliy to speak to us a few months ago, and he was kind enough to set aside time this afternoon to do it. And I was just reading an article, I don't know, on a investment website or what have you. And it was I've owned some of the pipelines in the past. So I was reading this article about pipelines, and I got about halfway through it, and I said, man, this is a pretty good article. This isn't the kind of stuff you usually just get from the financial press where they pull a couple quotes from one person who owns the stock and one person who shorted or whatever. And I looked down at the bottom and it was actually written by Vitaliy. I was like, oh, this is great. I'm glad I asked him to come speak to us because I thought it was a really good article. But he has close to 20 years of investment experience. He's taught graduate investment classes at the University of Colorado at Denver, and he also speaks to investor organizations in the U.S. and abroad. He's a CFA charter holder and has served on the board of the CFA Society of Colorado, and Forbes magazine have called him the new Benjamin Graham. So that's not too much to live up to there, Vitaliy.
Very low expectations.
Yeah, right. Set the bar. So just so you understand the audience here, all the students on here are graduate students in one of 3 programs. They're either in we have MSF and MBA students. So we have MBA and resident students, and we also have MBA students who are online students through our Kelly Direct program. Indiana has one of the top online MBA programs. And then we also have students who are Masters of Science in Finance students as well. So 3 programs, and they all kind of can come together in this class where we get together, talk about equity markets, and they put together a big equity analysis that they present to a board of alumni at the end of the semester. But we like to try to get some practitioners to come in and speak to us, and authors, and the students usually love that. So with that, I'll turn it over for you for a minute if you want to make any opening remarks or set the stage, and then we'll start hammering you with questions as soon as you'd like. So let us know.
Actually, I'll just make a little note. My son, who is 19, he's going to see Boulder. He's transferring to see Boulder next year. He has his best friend at Indiana University, and he got both shots of his vaccine. So he was just there, literally, probably in your campus, maybe 10 days ago.
Okay.
Anyway, okay. So I really don't have a lot of opening remarks, but I want to communicate one point to all of you guys. And there are a couple things. Number one, invest, don't gamble. And I think this point is kind of gets lost because right now, because a lot of because you buy a stock does not make you an investor. Okay, like in casinos, it's much easier, right? Because when you go to casino, it's a gambling domain, right? The chips, those are games, so that's gambling. Stock market, the kind of the line between gambling and investing is often ambiguous. I can be a gambler too if I buy a company that I know nothing about how much it's worth. I'm not really investing. I'm a gambler. Just because my title says CIO does not make me an investor. My process makes me an investor. So, and I think today it's very easy, just because you know the name of the company and even know its product, that does not make you an investor. What makes you an investor is going through the process, analyzing the company, figure out what it's worth, and then buying it. But everything, and the reason I'm telling you this is because I see all this behavior of people on Robinhood, and I just realized they really did not democratize gambling. I mean, investing. What they really did, they democratized a stock market to use a platform for gambling. So, and I think the way the app is created, etc. So that's point number one. Point number two, and this applies not just to me as a speaker, but to all the other speakers you're going to have in this class. The way I invest is appropriate for me. Like we run a 20, 25, 30 stock portfolio. Some investors run a 50 stock portfolio, some run 10 stock portfolio. The 20, 25 stock portfolio is appropriate for my EQ. It may be not appropriate for your EQ, your emotional quotient. So when you pick an investment strategy, what you want to do, you want to listen to what what you want to get out of these lectures of guest speakers. You want to look for insights, but you not necessarily want to replicate the way I do things. You want to take what I tell you and then ignore 90% of it, most likely. But if there's something that clicks with you, you want to see, does it really apply to me? Does it really match with my personality? Does it really match with my investment process? And so if you like, I'll give an example, because I do these things quite often. Somebody tells me, what do you think about gold stocks? And I say, I usually don't like mining companies because they're bad businesses. What you should get out of this is not that you should not do anything, you should not look at gold stocks. You should say, oh, why does he say they're bad businesses? You see what I mean? So don't just because I don't like these companies, first of all, I could be wrong. But second of all, I have developed over the years a lot of biases, as any investor does. But those are my biases. They shouldn't be your biases. Anyway, so these are my opening remarks. How's that?
That's great. So, so folks, if you guys want to ask a question, I think maybe just run that through. You can just put the question up on chat, or just say you have a question. I'll call on you, and then of course you guys all put together questions and gave them. So I have those. So I'll be moving those along. So Vitaliy, the first question already was submitted by Alexander Galt, one of our MBA students, and they wanted to know, kind of on that note, how did you go about developing your investment process, your philosophy, your sell discipline? How's that changed over time? What maybe are an example of, say, something recently that's changed in that? And then how do you adapt that to different industries, market caps, et cetera?
Okay, there's like 4 questions in here.
Yeah.
This is good. Okay. So how do I develop my process? So this is so investing is to some degree, it's like the way you develop is the way, everything about you, us, is path dependent, right? Your experiences shape you as a person. The interaction with other people shape you as a person. And so do interaction with other investors, the stocks you buy, the stocks you lose money on. Each one kind of contributes little by little, kind of molds you as an investor, as a human being. So when I joined the IMA, we were kind of what's considered to be growth at reasonable price. We're just buying companies we thought we can grow for a long period of time. And most of the return we were looking for to get was just from growth. Not much would came the price earnings, expansion. and maybe some of the return would come from dividends. That's the strategy of the firm, and that strategy worked for IMA's founder, did not work for me. That's how I was taught to invest. But then over time, I was introduced to value investing concepts, which were not at the core of IMA philosophy, by the way. And I kind of introduced value framework, but still with appreciation for growth. So see how I'm molded by exposed to IMA environment, and then I was introduced to value investing, and I kind of molded them together. So that's what basically happens to us as a human beings, right? It's a whole bunch of different factors, and then my self-discipline was just basically developed by reading a lot and thinking a lot about this. And there is a terrific book on selling called, it's by Don Cassidy, who's a friend of mine, and it's called "It's When You Sell That Counts." It is probably the best book on selling discipline, period, by far. How my selling strategy has evolved. So I realized I'm gonna own two types of companies. For one company, and I'm generalizing right now, it's gonna be a slower grower where most of the source of the return will come from not earnings growth and sales growth and dividends, but may come from price to earnings, expansion. Right? It was very cheap, and then it gets to fair value. So with these companies, my self-discipline has to be a lot more discreet. Like, when it gets to 90% of the fair value, I start selling and maybe start selling chunks. When then you have companies that have a huge growth runway, they are operated by kind of owner operator, somebody who started the company, or a CEO who owns a lot of the stock. And they have a high growth runway, owner operator, and they have high return on capital. So this company, so think about, you have this, think of it as company like Google, for instance. Okay, Google, your self-discipline should be a lot more like if you walk a dog and you have two leashes. There is a short leash for, you have a short leash for kind of a slow growing company, and then you have a long expanding leash for company. I'm just generalizing, a company like Google or somebody like that, because they have a huge growth right now. They have high return on capital, so they can take this money and reinvest in for a long time, because there's a huge growth runway ahead of them. And you have a management who is going to do the right job allocating its capital. So your investments, your self-discipline should be different between these two companies I described. Eric, did I answer all the parts of the question, or?
Yeah, I think the other thing, does your process and philosophy change by industry, or is that you don't really look at it industry, you're looking at it more like the discrete multiple expansion versus intrinsic value growth?
I think the only caveat would be if you're looking, it's a cyclical versus non-cyclical industry. Companies with, in a cyclical industry, those are more complicated. Those gets very tricky, because a lot of times when they're cheap, when they appear to be cheap, that's when they're expensive. Because what happens in a cyclical business, your earnings go from feast to famine kind of thing. It's just they go from nothing to a lot, and then to nothing again. And maybe even over the long run they're growing, but it's just there is a huge volatility of earnings. So when these companies look cheap, in a sense, the E is very high, and and the P looks low. That is actually when they are at the end of their cycle, and this is when you should be selling. So I'm kind of aware of that. In the kind of if I own cyclical companies, we rarely own them. That's, again, doesn't mean you should not own them, but it just does not fit well with my personality, with my with my IQ as an investor.
All right, so Andrew Conrad, one of our MSFs, had a question about kind of margin of safety. So one of our speakers was Monish Pabrai, and I think he came from the kind of opposite end of the spectrum, where he was deep value, and he's kind of moving more towards compounders. So he talked about when he was really doing the deep value investing, he would maybe look for something that's 40 cents on the dollar or something. So as you've added in kind of more and more of a value tilt into your process, how much of a margin of safety do you want to see in the investments that you make?
Let me tell you a story about Monish. So this is like 2007, 2008. And I'm speaking at the Value Investing Congress in California, and I meet Monish for the first time. And I talked to Monish, I said, Monish, how can you run this very concentrated 10 stock portfolio? Because those are very large positions. He's like, don't look at me, look at this guy. And he runs a 3-stock portfolio. So you see how for him, the 3-stock guy with 3-stock portfolio, that was too concentrated, and 10 was appropriate for him. But for me, 10 was too concentrated. And so that this is going back to my point that you really have to choose what's the right thing for you. The 10-stock portfolio is right for Monish, not necessarily right for me. So when at my firm, the way we look, and I think this is a very important mental model. You can modify the hell out of it, but it's actually a very important mental model. When you look for how much margin of safety you require from a company, one of the most important factors should be its company's quality. The higher the quality of the company, the less margin of safety you require. Okay, think about it. If you're buying a company which has a very predictable, stable, when you buy a Walmart, hypothetically, it has incredibly stable and predictable business with a huge moat, great balance sheet, right? For Walmart, you don't need as much margin of safety because there are fewer things will go wrong. And then you look at another company in that space that maybe have a lot more debt, may have a more fashion in their business. And then there, you need a lot more margin of safety because there are a lot more things can go wrong. Because margin of safety, all it does, it protects you from the future being not as good as you think it would be. Okay, so the future of a high quality company, the deviation from the future, of your expectations, probably not going to be as great. Again, I'm generalizing, and but I'm giving you a mental model here. Okay, where deviation for future is low quality company, the outcomes could be very, very wide. So that's how I would approach that.
So when you're looking at these compounders and so forth with high quality management, good growth, so forth, as the outcomes are maybe a little tighter, you wouldn't necessarily need the margin of safety as you would on, say, a cyclical company or lower quality.
Yeah, well, there was one point, one thing you want to stress is that a lot of times these companies, you just want to make sure the moat is there, right? That moat is there. We bought this company a while back, Twilio. It's a high-tech growth company, etc. When we were buying, the stock was so cheap that I could, at the time I could make an assumption. I didn't have to be very smart. In a sense, I could make very conservative assumptions. And with those assumptions, I would still not lose money. Okay, so in other words, that was my margin of safety, right? If as the stock price increased, my IQ had to increase exponentially at a faster rate than the stock price, because now, let's say you buy at $25, you can be assuming 20% revenue growth for a company in a fast-growing industry. That's actually was a conservative assumption, not typically, but in that case was conservative assumption. Now the stock goes to $75, and so suddenly you're now at 20%. Actually, you're going to lose money. 20% revenue growth. So now you're like, well, can they actually grow at 35% and 40% and 50%? And there you have to be so much smarter. So the issue is, how do you have to, the way, and this is what Monish was talking about, you want to buy these companies and then just pray that you are understanding of the business catches, kind of stays in line with when the stock price goes up, because anyway. So that's I'm not really answering the question, but I guess I'm giving you another example of complexity of investing.
No, I think that works. I think that works. You don't have a hard and fast rule of I'm buying something at 20% of what I'm doing.
No, we do. We do. We do a lot of qualitative work, but we also, for structuring portfolios, we have a quantitative frameworks that take our qualitative thinking and quantify it. And so our margin of safety will be, we use a required rate of return to figure out margin of safety, but it ranges basically from 15 to, well, it's probably, to make it simple, we're probably looking to discount somewhere 50 to 70%, roughly. I'm just, without going into the inside baseball of how we do things, 50 to 70%, probably most likely.
Okay. One of the MSF students, Justice Boyce, wanted to, when you look at companies that say are acquiring other companies, how do you look at growth that's organic versus inorganic? How do you factor in, say, synergies and acquisitions, or do you give a discount to inorganic growth rates? How do you look at those types of companies?
So when you own small companies, and I'm generalizing right now, it's a very general comment because there are a lot of exceptions to that. The way you lose money on those companies, a lot of times, is when management mismanages the business. Makes bad decisions about inside the business. When you own larger companies, usually the way you lose money is by management making stupid capital allocation decisions. Because, and again, I'm generalizing this, and so there are a lot of exceptions to this, etc. And this is what you learn from these talks. I'm looking at these big statements. There are a whole bunch of exceptions to them. But we own this company where they were a British defense company, and 5 or 6 years ago, they bought a business. So their business was running, basically repairing and servicing submarines in UK. It's a very good, stable, probably not very growing much business. To create growth, they bought from another company a business they were flight airplanes to put out fires, to bring rescue workers to different parts of the country, in this global business. 7 years later, they took a 1.7 billion, which I think is the cost of the whole acquisition, right down. In other words, they spent $1.7 billion of shareholder money and basically saying, we just threw this money away. Just think about this. This is a company, that's a half company's market cap. So I'm just gave you a kind of horror story. And by the way, there are a lot of those. But then there's a company, and we own a company, and by the way, if you want to study company that has created great value for shareholders through acquisitions, take a look at a company called SSNC, Sam Nancy Charles. Okay, it's run by Bill, and I'm going blank on the last name right now. He started the company from his basement in 1980s. And then little by little, he bought software companies, okay? And he would buy a software company, he would improve it, take out costs, and it may look on the surface, he would pay a high price, but after he takes out all the costs, etc., and integrates it, it's actually ends up being cheap. And he has done this for 30, probably close to 30 years. Bill Stone, the guy's name is Bill Stone. And he's done it for 30 years. So this is the company where acquisitions are in its culture. But I say this, if they start buying companies that lease aircrafts or build submarines, I'm going to get very skeptical very fast. Okay, but when they buy adjacent businesses that they understand, they bought a company out of Kansas City, GST, and that company, it was a mutual fund servicing company, and they had a profit margins of 12%. He took those margins up to 40%. Just think about it, from 12 to 40. And they're still growing. Like, so a lot of times you do this and you kill growth, and they're still growing. So my point is, when a company like that makes acquisitions, I celebrate. Oh, and the one little fact, Bill Stone owns 11% of the shares. So I know that from every dollar he spends, 11 of it is his, 11 cents is his. So if he makes a mistake, it's not going to be because of indifference. So, but so you see two contrasts, so when companies, also even when your companies in the same business make acquisitions. In fact, it's kind of, Eric, I'm going through the memory lane of all my, kind of my losses, and if I go back, all those companies at some point made an acquisition that just went bad. So, when I look at, when you have two companies with two service businesses merge, those mergers are very difficult as well, because especially if synergies are part of the strategy, and if they equal size, especially if they equal size, because now you come to just think mentally, you're working for one of those companies, and now this merger announced, and they talk about synergies, and you start thinking, am I the synergy, one of the synergies? And you start putting your resume in LinkedIn and looking for another job. And guess what? This is a service business. So now you're not thinking long-term, you're thinking about, because you're always going to think about yourself first. This is part of being human. And that's how these companies get in trouble. So when we analyze companies, this is something again, going back how my investment process, was developed by, through a lot of painful experiences. So
where do you come down? So again, like Monish was talking about certain sectors he just doesn't want any part of. Do you diversify across the economy, or are there certain areas that you kind of eliminate on the front end? How do you view that?
So there's certain bits, let me do this. Because I don't want to spend that much time on going into a rabbit hole. But I'm gonna, guys, if you go to sixcommandments.com, Six Commandments, download this chapter I have from like a book that I may publish someday. It talks about value investing, and there I talk about this concept of IQ and EQ, emotional, because and so because I think like this is probably one of the most important things you read, like from me at least, about investing, about the EQ and IQ. But anyway, so whenever you buy a company, that company has to be a good fit for my personality. Okay, so I usually stay away from highly leveraged companies, because I know that my EQ is going to be very low with those companies. When something bad happens, I won't be rational. I won't be going back to my models and rationally look at different scenarios. I'll be freaking out. So this is why we are designing the portfolio where I'm maximizing the little intelligence that I have to work as effectively as possible in in our portfolios. So usually I avoid for company. We usually have very low exposure to companies that are exposed to commodities. But see, this is, remember how I started this conversation, that because we do that doesn't mean you should be doing this. In fact, if one of you have has a lot of insights about oil industry or commodity industries, etc., that actually should, that could be actually your strength, right? And therefore, you should be looking at this and saying, okay, well, that's not for Vitaliy, but that's okay, that's for me. But so for my EQ, I mean, you usually stay away from very cyclical businesses, with a lot of debt. And I want high quality businesses. That means usually high return on capital, all these things, all the, good management, etc.
So Vitaliy, Chris Morton, one of our Kelly Direct students, saw in some footnotes that you had in your active value investing that you talked a little bit about some technical indicators, which isn't typically thought of with a value investor. Do you ever use those in your, buy or sell types of decisions, or is that just kind of on the margin as you're getting in or out of a position?
I don't know if you read my book, because I don't think I ever. The only time I talk about technical indicators that I only use them. So I think that's
okay. Well, maybe that was just a mistake there then. So, what about so you have kind of a lot of the Buffett value school of thought that's very qualitative and holistic, and then you have kind of a lot of quantitative value investors. If you're on the kind of Buffett side, is there a way to use some of the quantitative stuff to inform you, or do you have to keep those things separate? What are your thoughts on kind of holistic qualitative versus the more quantitative side?
Warren Buffett is a 90 something years old. I think he's not, I forget, he's 90, right?
I think that's right. Yeah.
I think he's 90 years old. He spent most of his life was when computers were non-existent, or at least they were not really accessible to, widely accessible. And therefore, he was formed as a person who can do complex math in his head, who can, who basically developed his skill set without computers for the most part. For a long time, I was saying, I don't need to use Excel because Warren Buffett doesn't use Excel. That was the dumbest thing I ever did. Because first of all, let's be honest. There's Warren Buffett's IQ, and there's my IQ, much lower. Just, so let's start with that. So Warren Buffett does not use Excel. I need any help I can get. Okay, so why handicap myself, right? If I was Warren Buffett, if I had a IQ of Warren Buffett, maybe I wouldn't need to use Excel. That's that's point number one. Point number two, all you're trying to do in investing is you have a puzzle. The puzzle is just basically there is a lot of information out there, and all you're trying to do is put this information together into, and try to understand, okay, what is this company worth? Okay, if running quantitative indicators will tell you, oh, there is the inklings that this company is a high quality company. I'll give you just an example. Like, let's say you look at return on capital for the last 15 years, and it's been very high and stable for a long period of time. Oh, there are inklings that this company has a very good moat. Does it mean that it has a good moat? You don't know yet, right? But it's actually, now you have a thesis. So just taking a whole bunch of information, using quantitative analysis, not technical analysis, but quantitative analysis, and to give you some data point, convert this complex, a lot of noise into useful information. There is absolutely nothing wrong with that. We use a lot of spreadsheets at IMA, and we have models that we do in a certain way, because I find that we do much better work that way, because we're not Warren Buffett's, So Eric, was that?
Yeah, no, I think that answered the question. Vitaliy, so Jonathan Cole wanted to know, how long do you spend analyzing an investment before you decide to buy it, and what are the kind of main factors there that are helping you make your decision?
All right, I'm so glad you asked me this question, because I want to run this new analogy by you guys, the brand new analogy. Any of you read sci-fi? Science fiction? Yeah. All right. Well, when you read science fiction, you're basically, or fantasy or something like, something that is, you basically, the author wants you to go in the world that's not this earth. That's not the world that you're familiar with, right? So, and there are science fictions that take place in the world that you know, and then they take place in the world that has completely different rules. Like, it could be different universe, etc. Humans look different or whatever. Okay, so if you are reading the book where the author is basically, the story is happening in an environment that you know very well, that you are in it every single day, then it's going to be very easy for you to get, to understand from the very beginning the whole story. If you reading something from Ian Banks, where he's building this brand new world for you, and there is all these different characters, all this, the rules are very different, everything is different. It probably takes you 1/3 of the book just to understand what's, kind of the world. Okay, and then you start to understand what's happening in the book. So if I'm looking at the company that is a kind of Ian Banks book that's which I know very little about, it's going to take me a lot more time to do research. However, here's the thing: once you read Ian Banks' book number 1, reading number 2 becomes easier because the world has already been built in the first book. So if I'm looking at company A, and then 6 months later I'm looking at its competitor company B, probably would have looked at it anyway when I looked at company A. But it's going to take me a lot less time because the world has already been built for me. Not for me. Already has built that world. So the amount of time it takes me to analyze the company is going to depend on how familiar that world is to me. How's that for the sci-fi? I brought some sci-fi finally into my speech.
So do you find yourself trying to stay kind of within that circle of competence type of stock, or are you constantly trying to grow that? How does that work?
So this is a fine. There's a fine balance by you trying to stay in your circle of competence, but you also try to always to increase, to grow it at the same time. And what makes this balance very difficult is that when do you step out too far that you lost, that you're too far from your circle of competence? But the thing is, if you stay in a circle of competence, you will never learn. That's basically it. So you always have to be able to grow it. Okay. I know my limitations. For instance, I was never a good student in high school, so my understanding of biology is very limited. So if I were today to analyze some kind of very, very niche biopharmaceutical company with one drug, where I have to use a lot of fancy language to understand the business, I know that I'm just not smart enough for that, or at least I don't have a tool, so I probably I know that not to go after this company. At the same time, I always try to find new industries to look at and to learn. And sometimes if I can build the world, if I can study build the world, then I kind of created my circle of competence. And what I would do in the beginning, I would take smaller positions, because when you are in the new world, you still don't know what you don't know. When I'm in my circle of competence, like something I've been before, I think I already know most of the unknowns. When this is when I'm going into new area for me, I try to learn as much as possible, build this world, but there are still things that I might discover that I did not know. I did not know. So our position size may be smaller in the beginning. So that's.
Right. So Daniel Roach asked, he had read your article on was our money manager kidnapped, and you talked about kind of this who, what, and how framework, and
Yes.
for sports betting. And he said, the what is often kind of easier than the who. So he wanted to know what types of strategies do you use at your firm to try to help identify who those future dominant companies are going to be in a given market.
It's very difficult. This light, that light, one, you have to identify the what. Identifying the who is so much different, so much easier if there's a hindsight. It really is. It's almost like if you look at Google, right? Now it's so much easier to say, well, Google, we all knew it's going to succeed. Well, you have to remember that there was probably another 10 other search engine companies that have failed. So, however, there were periods of time when, speaking of Google, where you already knew that it's going to be successful. It's not in 99 or 2002, but maybe 2006 or 7 or 8, where you already knew that they will be successful, that they already destroyed competition. So I think you need to, I think when you use this framework, you have to have enough humility to say, I don't know. I don't know if this company is the who, is the one. But constantly be watching for this. And when one emerges, that's when you start, okay, well, how much? You start figuring out how much. And in that article, I was talking about Uber, where I thought that was the who, for that space.
Right. So how do you actually go about kind of idea generation? Do you screen, or how do you come up with ideas that you then in turn look at and spend time on?
I do everything I can. I basically, we do everything. We run screens all the time. I read write-ups and news and letters by other value investors. I have a tremendous network. It's probably pushing over 100 people of value investors like me that share ideas all the time. I read a lot. Just anything you can think of that's rational, we do. I'm not asking for tips, from my cleaning lady kind of thing, but that's, but anything, anything that's rational, we do.
How do you how do you try to, I guess, obviously if you're screening for multiple expansion, you could look at lower multiples or things that have been lower than others. How do you try to identify some of the compounders?
I think the compounders probably not gonna this is where it gets, screening has a lot of limitations. It really does, because it doesn't capture well future margin expansion. Screening is extremely backward looking, right? So screening has a lot of limitations. So probably not a good place to look for compounders. You can look for high return on capital, but even that number will be understated if the company, for instance, taking all the cash flows and reinvesting into R&D. So it's not going to show up on the screen. Maybe you can see companies that have this high revenue growth, they'll show up on screens, stuff. But a screen has its limitations, and you're going to find certain type of companies. When we build a dividend portfolio, we were looking, we use a dividend screen. But what it did, it just gave us universe of companies to look at. And then one by one, we went through this universe, analyzed those companies, and kind of build a portfolio of 25, 30 stocks. But that's how screening has its own limitations. And this is what I really want you guys to get out of this. Investing is ambiguous. There is almost think about it, when a plumber comes to a house, he doesn't just come with one tool, or a handyman. He has a toolbox. And a hammer is a great tool for one thing, and it's a horrible tool for another thing. So there are you need to look at all these things that they all have limitations. Price to book. Let me give you an example. Price to book is a useful measure when you're analyzing financial companies, because book is marked to market every quarter. Price to book is worthless when you analyze technology companies. Because a lot of them don't even own factories anymore. Like Qualcomm is a technology company, they don't own factories. They design chips, somebody else builds them. So, so when I look at banks or insurance companies, even the insurance companies, there are some limitations to book. But when I look at banks, okay, book value actually is useful. When I look at software companies, I don't even know what the software, what the book value of Microsoft is, because it's irrelevant. It's a completely random number. So when somebody asks me, what's your favorite measure? I'm like, well, you are a handyman. What's your favorite tool? That's my answer.
Depends on the job, right?
Exactly.
All right. So one of our MSF students, Brooke Bailey, was listening to a Q&A call that you did a year ago, just as the pandemic was ramping up, and you said then that you wanted to focus on things that would not change as opposed to things that would. So, we're here a year later, and so she wanted to ask kind of, how has this played out? What would you have done differently, or what did you kind of learn from that process?
Wow, what a great question. Let me think. God, there were so many things. I was so wrong on so many different things. I was so wrong on the response of a government, our government response, because I was like I was basically at the time thinking that we have a superior system to Chinese government, and we would do so much better job than they did. And my God, I was so wrong about this. And I don't know if this is our government, if that's a chronic issue, or if it was just administration at the time. So I don't know the answer to that. The one thing at the time, I was thinking that at the end of the day, capitalism will win, and ingenuity of our companies will shine. And I think that's turned out to be true, when it comes to vaccines and etc. I did not if you nobody, I think nobody expected that you're gonna have 5 million people die. We're gonna borrow all this, we're gonna go through all this hell we went through, and the market will be making new highs. So in fact, you would argue that if we did not, just think about this. I wanted to kind of look back in January 2020, and let's say there was no pandemic, and fast forward a year, where do you think the market would be? I would argue, and again, I can't prove it to you, it would be lower than it is today. I want you to think about this for a second. I don't want to sound, I'm talking about people live, this, obviously there was a huge amount of human toll, people died. But from a corporate perspective, this was a net, there was some positives for the economy. And here's why. When the economy is growing for a long period of time, it's anything that's hasn't been stressed for a while gets kind of develops some fat inefficiencies, right? Because when you're going to be a lot when you're going to be in a very hospitable environment, you're probably not going to be as fit when you've been subjected to stress, right? So the reason you have expansions and then you have recessions, because recessions come in and they clear out, clear out all the fat, you become fit again, and then growth resumes. So the pandemic, when pandemic came, we were in the year 10 of economic expansion. So a lot of companies had basically got lazy. They had a lot of fat, And the pandemic gave them an excuse and a stimuli to basically cut the expenses tremendously. Like Uber laid off 1/4 of their workforce. And obviously they had to do it at the time, but if the pandemic did not happen, there is no way they would have inside the company they would be able to do this, right? Because if your business is doing fine and you come in and say, I'm going to lay off 1/4 of the workforce, it's going to destroy the culture. When you're doing this during the pandemic, I think people accept it much better. Like the acceptance from workers, at least people understand why you're doing it. So a lot of companies, what they did, they basically cut out a lot of fat. So the reason the market is where it is today, because now you look at the market, now these companies, at some point, the revenues will come back to, a lot of companies already have, come back to pre-pandemic level, but their costs are lower.
Mm-hmm.
Okay, so you have higher margins. The downside of that is that lower costs means you have higher employment. So I don't know how to, so you have positive and negative, and you have haves and not, and not have. So you have to, so this is something I'm still trying to reconcile. But to answer your core question, really, what has not changed? Probably one thing, like if I'm really critical myself, I should have spent more time thinking about what will change the digitization and paying more attention to that, because there were some companies that I understood the businesses and I understood the impact the pandemic has on them, and I just did not react. It's just, and maybe it was a shock, whatever. Like there was a company that I spent a tremendous amount of time on, DocuSign. And I looked at him and, I'm like, I get, like they like, no matter what happens, they brought the future forward, right? That's not, once pandemic is over, we're not going to go back to signing things on paper anymore. It's not going to come back. It's once you go DocuSign, you don't go, you don't go back. That should be their slogan, by the way. But I completely missed it. So those were my missions, and there were plenty of them. But at the same time, I think we stuck to companies that the difficulty to answer this question is, and this is a very important point. It only took 1 year or less for us to get vaccines. That is, like now it's, for us, it's obvious. Well, it's, 9 months later, we got a vaccine. Well, it was anything but obvious then, right? And if we got a vaccine 2 years later, then the way things would have played out would have been very different too. So I was creating the portfolio for that scenario. And so we still done very well, but I would have done much better if I positioned for the portfolio for vaccine in 9 months. And I think that's important to understand, is that what has had, on one side, our response was much worse. On the other side, the vaccines really have changed things tremendously.
Right.
So, and what I learned from this, like, I don't even know, like, I don't even know what to learn. I'm probably going to learn something, but I'm not even sure what to learn from this. So, yeah.
Well, it seemed like a lot of the students were intrigued by some of your articles, or your article on the Fisher random chess
Yes.
analogy. And so one of the questions, I guess Mackenzie Evans, one of our MBAs, had read an article in Bloomberg a number of years ago that a lot of Wall Street individuals had tried to learn chess because they thought that would be a skill that would translate and so forth. So given your background from Russia, where chess is a bigger deal in the U.S., have you seen any kind of correlation between that, or do you think that theory doesn't really hold water?
There was a lot of so this is a very good question. There is a movie, Searching for Bobby Fischer, and I forget the guy's name, but there's a it's based on a true story, and there was a guy there who was his who was a teacher, and he's a he had an interview maybe 15, 20 years ago. He said something about chess that stuck with me. Chess is a game of small advantages. I want you to think about it for a second. This is very important. When you start the game, you basically, everything is the same. Like you have identical position. And then with every move, you are either creating a small advantage or you subtract, or you do nothing or you subtract it. And at the end of the day, like when you go into mid game, then at that point, you already made, I don't know, 10, 15 moves. And a lot of these little moves start to add up. Like your bishops are positioned that they're shooting through the whole board. Your rooks are positioned so they're shooting through the open file. Your king is a little bit more secure. Your knight covers more squares in the middle of the board. And so suddenly all these advantages add up, and suddenly maybe your king is a little bit more protected, and therefore you're attacking his king, and you don't have to worry about your king. So if you have companies, like, so number one, this applies to me as a businessman running IMA. Like I try to constantly to improve us, just to give us a little bit more advantages, us to provide a little bit better customer service to clients, do a little bit better research, all this little, because these little things add up over time. But also looking at companies that constantly improve a little bit, all the time. So that's point number one. I think what chess is, it's basically an intense thinking. That's what it is. It's an intense and almost uninterrupted thinking. It's, to me, another analogy for chess would be writing, except my opponent, this chess is in chess, lately happened to be my daughter. I play a lot with my daughter, but when I write, my opponent is a white screen, is a blank screen. So, but it's a concentrated thinking. And therefore, if you think about it, like we spend a lot, if you think about our health, going to the gym, etc., because we want to work out our muscles. But brain is muscle too, and chess to me, it's just, it doesn't have to, that analogy doesn't have to necessarily go to investing. It's just via just exercising our muscle, our thinking muscle. But the Fisher random chess analogy, I think was one of probably the best analogies I ever come up with for that environment, right? Because, and guys, if you haven't read that article, I'm not going to regurgitate it here just to save time, but read it. It's and it's going to make more sense, because that analogy allowed me to figure out what to do. Allowed me to erase, basically, can reset all my assumptions, and say, okay, if I knew nothing about, if I didn't look at history, if I tried to stop looking for patterns, not look at history, how would it be looking at my portfolio? What could happen? This kind of thing. So I'm not really answering the question completely, because but here's the interesting part. If you gave me this question and I sat in front of a computer for 5 hours, I would have given you such a great response. Just because, and that's because at that point I would go through all the different versions of my thinking, right, and throw out a bunch of extra things and left 5 things, whatever. So, but that's the beauty of writing, by the way. I'm gonna diverge for a second. The most important thing that happened to me as a human being, I'm not talking about having kids or being married, aside from all that stuff, writing. I write about 1 or 2 hours a day, every single day. And that is writing is focused thinking. Okay. So if you write, you don't have to publish it. Just write it for yourself, write a journal. But writing focuses you. It's the most focused thinking you could possibly do. So I highly recommend you guys do that.
Is there anything that you've learned from the pandemic that's caused you to change any part of your process or philosophy?
My immediate response probably would be no. But I reserve a right to change my mind because I don't know. As of right now, not really.
Okay. What so William Mucci, one of our MBAs, said, it seems like one of the hardest things to do in investing is to assess the people running the business. What kind of tips would you have for trying to assess management strengths and weaknesses?
That's a great point. That's a great question. So it makes it a lot easier. It's not bulletproof. If whoever runs the business owns a lot of stock. So that simplifies things a lot, tremendously. You look at their past decisions and see what they did in the past, and you analyze that. Then you listen to them talk very carefully. If they keep talking about how they beat the estimates, or how they crushed the guidance, or whatever, those people are going to be short-term oriented. And this is important to understand. When you run a business, a lot of times there is a short-term and long-term are somewhat opposing to each other. In other words, long-term success a lot of times comes at investments that happen in short term. Okay, and the short-term investments mean that you will have lower earnings. You have lower earnings in the short run, but then as when they pay off, that's going to help the company. If you look at Amazon, right? That's what Amazon was able to do, right? They would grow revenues, they would take and generate cash flows, take all these cash flows and put it back into the business and basically natural profit. Okay, and Jeff Bezos said something that's been stuck with me, and actually as a CEO of this company, I think a lot about this. He said, when people congratulate me on a good quarter, guys, I say thank you because I'm trying to be polite, but in reality, what I did in this quarter had absolutely nothing to do with this quarter. This quarter has been decided for 3 years ago when we made investments that paid off in this quarter, right? And I think about this when we run this business because we can be doing a lot of things right, but there is a delay between our decisions and the outcome. And so that's probably, I'm kind of, again, going on a tangent, but going back to your question, Eric, I think, in other words, does the management own the business? Look at the past decision, look at what they say. And also look at the compensation, how they compensated, if compensated short-term or long-term.
You look for certain at the metrics they're being used as. So in other words, if you're want a high quality, high return type of business, are you looking to see if management is being compensated off earnings per share or off return on capital, those types of aspects?
You would look at how yes, you would look at the compensated earnings, cash flows, etc. Yeah, yes. Yeah.
So there were a couple of questions kind of on that an article that you had written on your cell discipline, and I think you were talking a little bit about the short leash and the long leash. Yeah. So if you're on that company that you think has a high growth runway, has quality management and so forth. Maybe an environment like this where they've really gotten run up. So yeah, you're letting it go, but when do you actually pull the trigger and start to sell those compounders because the multiple has just gotten
Yeah.
much more than
Yeah, there are two decisions when you sell. There are two decisions. It's a when so when you think about sell discipline, you think about it as binary. You either own it, you don't. But it's in reality, it's not like that. I can be selling little at a time as the stock goes up, right? And so with the compounders, I'll be selling 10% position, 10% of the position over a period of time. And at some point you just run out of stocks to sell, basically. But you keep selling in small increments.
All right, so there's a couple of questions that I kind of put together from students that are really has to do with kind of the behavioral finance aspect of that EQ aspect that you're talking about in terms of like um, when do you actually sell a loser or reevaluate what you've done, and how difficult is that to kind of admit when you're wrong versus trying to um, stand against just the market not going your way. How do you go through maybe a process where you buy a company, you think you know it pretty well, and then the stock market isn't going with you, or something happens that you didn't expect?
So this company I mentioned, the British defense company that got into the flying rescue helicopters and planes and stuff. 2 months ago, they came out with press release saying, they had a new management. They came out with a press release saying we're not sure if the value of the contracts for the airspace, for the plane business, if those contracts actually, if the count on this contracts was right, if the assumptions were right, suddenly 1/3 of the business, we have no idea what it's worth. Just overnight, I thought it's worth this much. And so what we went back to our models and say, okay, well, how much is the rest of the business worth? And figured out, and figured out that, the kind of the submarine business that's kind of been new, that hasn't changed. And based on that, is you guys still there?
Yeah.
Oh, okay. Somebody I lost. Oh, here it is. Okay, got it. So we looked at the core business, and we realized that we're gonna make less money. No, sure, for sure, if that business is worthless, but the company is still worth more on the rest, on the 70% of the business. And in that case, we basically decided we're gonna do nothing for now, and then we'll see. So because we just that's all we had. We said because they said it may be worth less, and so anyway. So in other cases where we have in other cases, we look at the business and we thought it was a certain quality and it's not. And then we say, well, can we use the money somewhere else? We sell it and buy something else. There is no, it's very difficult to give a prescription. It's kind of, we do one thing at a time. And it is probably the most painful part of investing, is that because you basically, when you sell a company that stock has declined, you basically, by selling it, you're admitting a mistake. And I like to admit mistakes as much as everybody else. So but you learn to do this over time. You learn to do it over time and just move on. In fact, one thing I found is that I have two companies that are we own 30 companies. We have two companies that are giving us, kind of indigestion right now. One company I just talked about. And I don't remember a period of time where every single company did great. In fact, I'll tell you this, if I sell those two companies right now, those two companies give me indigestion, I'm sure somehow the other two will surface. For some reason, there's always one or two companies that are something not going right. but that's part of investing, right? That's why it's not a portfolio of, it's a portfolio of 20, 30 stocks, not a portfolio of 2 stocks. For me, somebody else could be a portfolio of 2 stocks.
Yeah, if you have 2 going bad out of 3, then you're really in trouble, right?
That's right.
One of our students wanted to know, what kind of things do you look for when you hire investment professionals, and what can they do while they're students to improve their attributes as value investors?
All right. So, Eric, after we're done, I'm going to send you a link. We created, like last year during the pandemic, I wanted to give something back to the society. And I created this curriculum for you guys, for students like you guys, where basically I took all my best investment articles and some excerpts from my book and put them into kind of email curriculum. So you just go one at a time, So there I have this article that I wrote on that topic. And I think it's called The Letter to Young Investor. And I basically was writing to myself 20 something years ago. So we, about 2 years ago, we went through a process of hiring an analyst for my firm. And so I had to think a lot of time, I spent a lot of time thinking, what am I looking for in that person? And somebody told me this saying by a famous basketball coach. He was approached about, kind of recruiting this player. And he said, and whoever was trying to teach him that player was saying how great he is. And then the basketball coach said, but you know what? You can't, you can't change. I'm butchering the quote because
Can't coach height.
Yes, you can't coach height. Thank you. You can't coach height. And that is, to me, in investing is passion. I can teach you, especially if you came out of business school, I can teach you, I can tweak how you look at balance sheets or how you look at cash flows, all these things are teachable. If you don't have a passion for investing, I can't teach you that. Like, it's one of those things, either that fire is burning or it's not. If it's not burning, you should not be doing this, because you will be competing against people who are maniacs. Like a fellow that works for me, Brendan, he's the guy who I hired. He's reading 10K for breakfast. He receives joy from doing this. Try to compete against him. If you really don't find joy from doing this, you're gonna have a miserable life. You're gonna have a very miserable life. So I would say, don't go into investing or into anything for that matter, because you only live once after all, if you're not really passionate about it. Okay. And I know that there's some other gurus tell you don't do this. I would not want to live a life where I do something I don't enjoy. So, and Eric, what was the question? There was I'm kind of avoiding the question.
What can they do to improve themselves as value investors? What do you look for when you're hiring? And it sounds like, passion was what you were looking for, and then what they can do to improve their themselves.
Yeah, and so let me tell you how I hired. But how do you figure out if somebody has a passion? Let me tell you how. You set the walls very, very high for somebody to jump through before when they apply for a job. I intentionally made the process of getting hired very laborious. I forget all the things I did. I asked for a list of books you read last year and what you learned from them. I asked for people that had impact on your life. I forget how many people and why. I asked to give me a write-up of your past companies. It was a lengthy process. And somebody and we posted on LinkedIn, and somebody says, so I'm gonna go through this, I still not get a job. Why would I do that? Like, that's exactly the point. If somebody wanted the job bad enough because they really have passion and they wanted to be here, then they would go through all this, through all this. I forget the numbers now, but I think we had maybe 50 applications. 35 of them did not include anything but resume. I did not even look at a single one of them. Like, honest to God, they did not exist for me. And then I forget, maybe 10 or 15 were actually did the work. And I think we ended up, I don't know, interviewing 5 or something. And when I hired Brandon, that was the easiest decision I ever made, just because everybody was here and he was right here. And that was, and the factor was just so easy to see. In his write-up, I could see he's very thoughtful. Actually, the 3 write-ups he sent me, I disagreed with a lot of his conclusions, but it didn't matter. I could see he was thoughtful about his write-ups. And I could see he had passion, and he was intelligent.
What, so this was from Christopher asked, is there any common advice in the industry or from the academy that you strongly disagree with when we're talking about investments?
So I'm like, I have this dilemma right now, because I'm talking to students that go into school that have a curriculum, and I probably disagree with half of the curriculum. So do I just continue? Do I just say anything or not?
Yeah, because the next question is about the academy versus practical, and how do you rectify those? So we're going to get there. So you might as well talk about it. You're not going to offend me.
So when I was a student, just like you, and I have a MS and I have undergraduate in finance and a MS in finance, I learned about modern portfolio theory. That was one of the most exciting days in my life. Honest to God, I was like, oh my God, you can do this, this, and this, and you got a modern frontier, and you can figure out how to stocks. That was so exciting. I honest to God, this, like, I'm not exaggerating. I was telling my friends about it, and they thought that I was crazy. And then, in the beta, the beauty of beta, how it's the risk, all these things, it marries these things together, and I loved it. I absolutely loved it. And then I got a real job, and I haven't used the word beta since. And I don't even know what like, if you are honest, and this is not exaggeration, if you ask me for a beta of any companies I own, in fact, if you ask any value investor, anybody in my community, what is the beta of their stock, they would have no idea, because it's something that it kind of stays in academia. It's what it does. It stays in academia, or it stays with consultants, because consultants. So the problem is there is so much when you have a lot of computing power and you try to put what we do here into beautiful equations, you may still get a Nobel Prize for that, and Harry Markowitz, I think, did. But it's very precise, but it lacks common sense. Like, let me just pick on a few, like beta. Like actually, I went on a small rant in my first book, Active Value Investing. So I think I showed the beta for Budweiser, and that beta was, when I forget the numbers now, from 0.6 to 1.2. Oh no, from 1.2 to 0.6. And the only reason I did this because stock market declined and stock didn't. Did the Budweiser get less risky as a business? Just the things around it happened. The beta changed. So when I started doing it for a living, I realized that this beautiful, elegant capital pricing model, it works so well, but you have to make this assumption that people are rational. Let me just give you this example, and I hopefully you'll be able to relate to this. Imagine you are working for Boeing, and you just took a physics class where they said the gravity does not exist, and they tell you, go build a plane if gravity doesn't exist. it makes no sense, right? Because the gravity, and that's what kind of when the capitalist price model says people are rational, then it's basically saying that gravity does not exist. And so you're trying to build a plane, assuming there is no gravity. I would not want to be on that plane. So that's my rant of the day for about what I wish my kids would never learn.
Daniel Roach has one that's a little more philosophical.
Love
He
it.
talks about in one of your articles, you quote Warren Buffett when he said, as an investor, you get something out of all the deadly sins except envy. And you went on to kind of explain how investors, you have a lot of power to get rid of your suffering by not wanting the wrong thing. So as students and professionals early in their career, what kind of virtues should they be trying to internalize to get the most benefit from their career? Career advice, life advice type question.
Wow. Thank you, Dan. I appreciate that question. So what, well, so I think in an article I was doing, I think, is that the article where I talk about coveting your neighbor's wife? Was that the article?
He didn't give me the title of it, but I think that was.
Yeah, no, I think that was it. So in that article, I basically talk about, and then we'll kind of get to your question. I talked about how I was talking to a friend of mine, and I forget how the conversation came about. But I asked him, "Would you want Warren Buffett's success?" And he's a value investor just like me, and he was completely stunned by the question. He's like, "Is that a rhetorical?" He asked me, "Is that a rhetorical question?" I said, "Absolutely not. Would you want Warren Buffett's success?" He's like, "Absolutely." I said, "But here's the thing, though." And this is like my wife told me, there's this Jewish wisdom. If you want somebody's success, if you covet something, like in your neighbor's wife, for instance, which is one of the commandments in the that says don't covet away, but do it in the entirety. Okay, and this is think about it. So when we are envious of something, we only see a part of it. We only but if you see the whole picture, you may say, actually, I may not want that. I may be happy with what I got. So if you look at Warren Buffett's success, obviously, incredibly successful person, but that's the asset side of the balance sheet. But look at the liabilities the costs he had to incur to get there. His wife that he loved dearly left him. His kids basically felt like his father did not pay attention to them. When I read Alice Schroeder's Snowball, the only thing I remember getting out of that book about Warren Buffett was, I don't want to be as a father like Warren Buffett. Because, and I'm so lucky I read it when it came out, that I was able to change my behavior, and actually did change my behavior, and started. It's so much, as an investor, it's so much easier for me to just be in my kind of natural environment of reading, building spreadsheets, etc. It's so easy for me to work all the time. But what I do, what I do to myself, I force myself to spend time with kids. By the way, this sounds like I don't want to spend time with my kids. That's not the point. Actually, I do, but it's not. I have to interrupt something that's flowing, and get into another flow that I'm going to enjoy once it starts flowing. So I have to go from one environment to another, and I have to force that. So whenever you look at somebody's success, or you look at or you look at your neighbor's wife, just remember that you see the beauty on the outside, but but you're only seeing part of the picture. And once you get to know this person, with all the other things that come with it, you say, actually, no, maybe she's not for me. And this happens all the time. So I'm basically what I learned, I don't want to make regrettable mistakes, I guess. Like, and for me, and you guys, a lot of you are too young for this, some of you are not anymore. When your kids, your kids being young only happens once. And for me was the mistake, the lesson was that I want to make sure that I'm there when they're growing up, so I don't have that regret. Anyway, so that's not, I know that's not where I don't know, Dan, if I kind of answered your question, but that's probably one of the biggest takeaway. By the way, there were so many things, positive things we can learn from Warren Buffett, and I talk about those things in in the article. But one thing is that I really respect is that you want to have your internal scorecard. You basically want to make sure that you are not trying to, your happiness or unhappiness is not determined by what other people think of you. Okay, so at the end of this speech today, I hope that I have impacted you in a positive way, and I'll try very hard to do this, but that's all I can do, right? So I just so the way I judge myself, I should be happy with what I told you. If you're gonna like it or not, I have no control over that. And there are a lot of things in life like that. The worst thing you can do is try to, and this is why the social media is so poisonous, because you basically look for constant likes and from strangers, right? And your self-worth is basically dependent on things you can't really control. You write and as a writer, actually, I kind of, it's kind of the interesting part was this. The best article I wrote last year was, look it up on my website, called Art or Craft. And I felt this is the best, most insightful article to me I wrote. I had no response on the article. Nobody cared. And you know what? I'm like, okay, they didn't care, but I cared. And that's, I cared and I learned from it. And anyway, so this is what I learned from Buffett. One of the things I learned from Buffett, I guess. So.
Yeah, well, Vitaliy, I know we're getting late here, so in the time that we asked for, but I do have a question. IU is the home to the Jacob School of Music, which is one of the top music schools in the country, and we actually have a student who was at the Jacob Schools, Caleb Cranton, and he noticed your love for classical music when he was reading some of your articles, and wanted just to ask you, what draws you in about classical music and makes you want to learn about that? When did you realize you loved classical music? And I thought I'd kind of end the question on something that was of real importance to you. And and so I'll just let you answer that for a moment.
So my parents listened to classical. My mom played piano and violin. I think she actually was a very good violinist. So we listened, my parents listened to classical music at home. And I think that's how I was introduced to that. And as I got older in life, it's almost like the other music did not have enough emotion for me. And the complexity of the thing about classical music, and I'm generalizing right now, right? It usually has a lot more layers of complexity, and you can listen to the same piece many, many times, and every single time you uncover a new layer. And also, music has this kind of as you can probably see, I'm a fairly emotional person, and and then what music does, it's actually unearths even more emotions. And it's really just changes how I feel. It just makes me feel good. It's really that simple. And when I write, I put my headphones on, and this is when I listen most of my music, just in the morning when I write or when I go for a walk. And that's inadvertent. And then what happened, actually, this is kind of interesting. I told you guys how writing had a huge impact on me in my life. one of the things that happened also, this has happened maybe 10 years ago. I wrote an article, and I was listening to to something at the time, and that piece had a huge impact on me. And I threw a link to YouTube link at the bottom of the article. I say, and by the way, here is the piece by whatever. And that was it. And then that started a tradition where I started to attach music at the bottom of my articles. But the problem is, like, it's in addition to attaching this music, I started to research it more, and I started to read about classical music composers, conductors. I started to watch a lot of videos about them, and that process, by me writing about it, made me read more about it, which meant I wrote more about it. And that basically, in fact, I have a website, myfavoriteclassical.com. If you want to learn about classical music, just go there, and there's a lot of, there's a lot of articles about classical music. But I find that classical music has just made my life. It's almost like it added salt, like in a good, like it's when you add salt to a meal, it brings out taste. It did that to my life. It just made my life taste better, I guess. That's the analogy again. So.
Well, that's great. So, Vitaliy, I just want to thank you for your time today. If you ever decide you want to, is it your son that has a friend here on campus? If you ever want to come with your son, let us know, and we'll try to get you over to the Jacob School and then over to the Kelly School to speak to some more students. But really appreciate you taking the time today and speaking with our class.
Eric, thank you so much. And guys, great questions. I really enjoyed I Zoom, I guess, is better than nothing, but obviously when you have a real experience, it's so much better. But it's it's great to be here, and I really enjoyed the questions, and thank you for inviting me, I guess. Yeah.
All right.
Thank you.
Thank you very much.
Bye-bye, guys.
Thanks a lot.
Okay, bye.
Thank you.